Happy New Year, everyone, and welcome to Market Outlook 2022, a game of chutes and ladders. The reason we gave it that title this year is because that's what the market was like last year. It was like that old game we played when we were kids where you roll the dice and you try to make it up the ladders, get to the top of the game, the top of the board. You win when you get to the very end at the top, but inevitably along the way you end up falling back through chutes, or in other words, slides, sometimes big slides, sometimes short slides, but inevitably it definitely wasn't a straight line up, that's for sure this year. And between the choppiness and the volatility in the market, there was also the phantom correction that took place amongst a good chunk, if not the majority, of individual stocks within the stock market, not to mention the bond market, which was actually down this year as well for the fourth time in 45 years. So we're going to be talking about that. A couple things real quick. First of all, want to make sure that you change the quality on your YouTube channel. So the little gear button that you have there, you're going to want to make your YouTube screen full screen so you can see these charts and tables as easy as possible. Once you hit the gear item or gear icon, you're going to be able to see that you can change the quality of the video. You want to make that as high quality as possible so it's as crisp and clear to see as possible. There are a couple charts that I didn't want to omit because I thought they were good, but they're just a little bit blurry, so even at high quality they might be tough to see. I just want to warn you in advance. But we want to make sure you're seeing this in the highest quality possible. And then second of all, I normally don't have this much information. In fact, if I go back to every quarterly scouting report, market outlook, or halftime report that I've ever done in my career, I don't think I ever had as many slides and pictures and charts and tables as I do today. So on one hand, I want to apologize in advance for all the information, but more so I want to apologize in advance for the fact that I am going to move very quickly. So the second housekeeping item is that I want you to be aware of the fact that if you're on your keyboard, whether it's a laptop or PC, you can use the left and right arrow keys to jump forward or backward 5 to 10 seconds. Of course, you can always pause and rewind. And then if you're on a handheld device like an iPad or a phone, once you have it in full screen mode, you can double tap the left side of the screen or the right side of the screen, and that will jump you forward or backward by, I believe it's 10 seconds. If you do it over and over again, it'll turn into 20 seconds, then 30 seconds, and so on. But the point is, I did cut some things out of this presentation, but I got to a point where I felt like there was so much good information that I had a hard time cutting anything else out. So instead of cutting more out and having this market outlook this year lose some value, I thought what I would do instead is I would leave it all in and just go faster. So let's go ahead and jump right into it. First and foremost, I guess one more piece of housekeeping, our good old disclosures. The following presentation was recorded on Tuesday, January 4th. The time right now is 4:04 p.m. The market just closed. All data provided is based on the daily close of the U.S. stock market prices varying between early December 2021 and as late as midday Tuesday. That's today, January 4th, 2021. I'm sorry, 2022. It's a mistype. Market prices are subject to change. No opinion stated herein can constitute a prediction or guarantee of any future results, nor should any of the information be taken as investment advice. Past performance is not indicative of future results, and of course, always consult with a qualified financial professional before investing. So I want to go over our agenda first. Our agenda today is first we want to wrap our heads, or at least attempt to wrap our heads around the bifurcated 2021 that we just walked away from. The second item is the biggest stocks are getting bigger, and how that's disguising the market indices and what's really going on underneath the surface. It's kind of like the Phantom of the Opera, except it's the Phantom of the stock market here. A third item is a look at some of the stocks that did well, and then fourth, a different look at just a handful of the many stocks that struggled. In fact, that's a big portion of what I cut out today is a lot of stuff that didn't do well because there was just so much of it that I went, like I said, I just went overboard. So that's item number 4, looking at just a handful of the many stocks that struggled in 2021. Fifth item, the bond market. It was down for the 4th time is all in 45 years, and we'll look into a couple details there. And then last but not least, we'll look ahead at 2022, some information that is generally, in my opinion, positive. Obviously, there's always risks. There's no such thing as a market without risks, but I'm feeling pretty good about 2022 going forward. So quote of the day, I always have a quote, of course, and the quote of the day is, "An optimist stays up until midnight to see the new year in. A pessimist stays up to make sure the old year leaves. And I think when we look at this last, not just last year, but last several years between COVID and all the things that all of us are going through with our families, our health, I think that we want to try and stay optimistic, stay positive, stay cup half full. And for those of us who did stay up until midnight, like my wife and I, Don and I and the boys actually stayed up until 3 in the morning playing games, believe it or not. I can't believe the boys made it. But anyway, I digress. For those of us that did stay up till midnight, that you were staying up to midnight to see the new year in and optimistically looking forward to what we see ahead of us here. So with eyes wide open, let's jump into the meat of the material. What happened in 2021? Well, first of all, I'm going to share some quotes about some other, these are friends of mine in the business, other professionals, other portfolio managers. The first is my good friend Andrew Thrasher. He said it's not normal to be less than 2% from a high, while the typical stock within the stock market is down nearly 12%. But there's hardly anything normal about today's stock market environment. And then the second quote here is Mark Minervini. He's repeatedly one of the best investors in the country, has won the U.S. Investors Championship several times. He's an author of, I believe, 3 or 4 books on trading and investing. But he said, I would describe the trading in 2021 in 2 words: no legs. Some stocks made nice moves, but this is probably the most bifurcated market I've ever seen in my 38 years of trading. You have a list of stocks that are down 40 to 80%, but the S&P 500 is less than 1% from its high. So that just kind of goes again to talk about this bifurcation, which is a word I swear that I hope I never have to hear in 2022. But it just goes to that bifurcation and how the market itself, when you look at, say, the Dow or the S&P 500 index, is very, very, very different from what's been really happening underneath the surface of the market. And basically it's been a disguise. It's chutes and ladders and the phantom of the stock market. This is a picture that my friend Ian McMillan posted on Twitter. I just thought it was funny, and it kind of, again, speaks to that bifurcation. You've got the S&P 500, or the Dow, let's just say, would work as the plane here, kind of flying away and smiling like no big deal. Meanwhile, you've got your stocks, their stocks, her stocks, his stocks, that are all just exploding or imploding, depending on your word of choice here, behind the scenes. So, again, really good. If a picture could speak 1,000 words, then I think this one does that very, very well when discussing 2021 and what the stock market was, how the stock market behaved. Moving on further here, objects in mirror may be closer than they appear. Again, just talking more about that bifurcation. While the S&P 500 performed well in 2021, only 25 of the stocks on the S&P 500 accounted for more than 40% of its weight. And we're going to talk a little bit more about weight in a second here, but keep this in the back of your mind. So while the S&P 500 performed well in 2021, 25 of the, by the way, 505 stocks are on the S&P 500, 25 of the stocks in the S&P accounted for more than 40% of its weight, because it is a weighted, cap-weighted index. In other words, the biggest companies move the market, whereas the smaller companies, and it doesn't have to be micro caps, by the way, just the smaller companies that are not mega caps do not move the index as much. So if you've ever watched any of my older presentations, then you know I like to use the analogy of the generals versus the troops. You know, the generals are the big, huge, Microsoft, Apple, Google, and Nvidia, Facebook, and so on. These are the stocks that largely waged the war, but they waged the war in 2021 largely alone. The troops are the smaller companies. Now, we've heard a lot of these companies before, and I'm going to show you some charts later, but we've heard of these companies, but they haven't done nearly as well. And this is where we kind of get into some of the details. For instance, over the holidays, just pulling some random numbers back from different time periods, only 26% of stocks, 26.34 exactly, were within 10% of their highs earlier in December, which is the weakest number that we'd seen since November of 2020, so in more than a year. Moving on, 41.5% of stocks were trading down more than 20% below their highs. In other words, almost half, or closing in on half of stocks in December, about mid-December, were down more than 20%. And these are the stocks within the S&P 500. The percentage of the stocks hitting new lows, not new highs, but new lows in early December, hit almost 10%, which was the worst number we had seen since the COVID crash. And this is, again, while the index is doing well, we're seeing stocks within the index flash warning signs saying, well, not only warning signs, because obviously that's what this is, when we start to see the stocks within the market flashing huge percentages of new lows, that is a warning sign, of course. But more importantly, especially in the when we frame 2021, it just shows that there's a lot of stocks within the stock market that just are not doing well. And then bonds, I already mentioned, but bonds were down for only the fourth time in 45 years, which means that any, we'll call them more conservative portfolios, these are things like moderate growth portfolios, which may have 20-25% in bonds, balanced portfolios, which may have anywhere between, call it 35 to 50% in bonds, conservative portfolios, which could have 40, 50, 60% in bonds, actually didn't help you at all. The bond market didn't help. Instead, it hurt to own bonds. That doesn't mean you avoid owning bonds altogether, of course, because bonds pay interest, and we want to collect that interest. But it was a very, very difficult year overall for bonds as well. And then when you look at the average Russell 3000 stock, and for those of you who don't know what the Russell 3000 is, there's the Russell 2000, which is the small cap index. That's basically an index of small companies. The Russell 3000 is almost every investable stock that you could buy on the U.S. stock market. But it's a good proxy for the entire market, we'll just say. And the average Russell 3000 stock earlier in December was down as much as 50%, which was a pretty crazy number. Now, I mentioned earlier in our agenda that the biggest stocks are getting bigger. In other words, think generals here, not the troops. When our generals are going to battle, you want to have your troops behind you because you don't want to get, mowed down by the battle ahead. So we've got our generals that are heading ahead here. And as you can see here, this is Charlie Bolello. He put together this chart. The S&P 500, the weighting of the top 5 holdings in the S&P, 23.5%. So in other words, the top 5 stocks in the S&P 500, which is 505 stocks, the top 5 stocks account for more than 23% of the entire index. So when those 5 stocks move, they move the whole index, up or down. If they're having a bad day, the index has a bad day. If they're having a great day or a great month or a great quarter, then those 5 stocks are going to move the index. Here's another one. This is from Andrew Thrasher. He used Koós to get this data, but when you look at, this was a 3-month return, so it's just comparing a 3-month trailing return. The top 30 stocks accounted for 73% of the performance in the S&P 500 index, looking at 10 different stock groups. So again, I'm just kind of showing how what's the word I'm looking for? How deceptive, I guess deceptive is a good word, how deceptive looking at a market index can be. In other words, by saying just because the Dow is up means everything should be up. And that's definitely not the case. In fact, I just brought up the Dow. The Dow is only 30 stocks, and that's it. Now, this is one of the charts I mentioned that was a little blurry, so I apologize that this is so hard to see. But there's 2 things here. First, on the left-hand side, we've got the NASDAQ, and I believe that's blue or turquoise. I'm colorblind, so I apologize. And I think the other line's orange. It could be green. It could be yellow. When I make my own charts, I customize them so I can distinguish them apart. But I'm full disclosure, I'm colorblind here. So the chart that's going up is the NASDAQ. Now, the chart that's going down, and I believe it's orange, or I'm going to stop embarrassing myself here and stop talking about what color it is because I'm probably horribly wrong, and there's nobody here at my office right now that I can't borrow their eyes. But this is the chart going up is the NASDAQ. The chart going down is the NASDAQ without its 5 biggest stocks in the NASDAQ. So if you removed the top 5 biggest stocks for the NASDAQ, and this is as of December 6th, so this is a little bit old, and it came from S&P Global Market Intelligence, you can see how important just those 5 stocks were. And the NASDAQ's not a small index, by the way. The S&P's 505 stocks. The NASDAQ's much bigger, and we'll talk a little bit more about that in a second. On the right, Kathy Wood is one of the most respected, one of the best portfolio managers in the country. She did extremely well, especially through the second half of 2020 after the COVID crash. And she said, I've never been in a market that is up, that has appreciated, and our strategies are down. That has never happened before. Now, the part where it says Cathie Wood lying or forgetful of her pre-ARC days, ARC is the name of her ETFs, by the way. Her funds are ARC funds. I don't know that she's lying. I don't agree with that statement, I guess, is what I'm saying. But the point is one of the best portfolio managers in the country, who manages over $600 billion, I believe it is basically saying that she doesn't recall a time, at least, where she's been in a market where the index has gone up, but her portfolios have been down dramatically, and she's one of the best. So this is another really cool chart. I'm going to spend a quick second on it from, again, Andrew Thrasher, a good friend of mine in Indianapolis. And what you're looking at here is the S&P 500 in the top pane, and in the bottom pane, you're looking at the outperformance, or the percentage of stocks that outperformed the market each year. You can see in 2017, good year, lots of stocks outperforming. In 2018, not a good year. In fact, there were only blips of time where the percentage of stocks that were outperforming were over 50. Then you have 2019, not a bad year. Started better than it finished, of course, but not a bad year, 2019, where you had a lot of stocks that were outperforming the index, and obviously an opportunity to make index-like returns, or better potentially. 2020, horrible year. As you can see, I think that goes without saying. COVID, rough year. I don't think I need to discuss that. 2021, there's our chutes and ladders. It's all over the place. The first 4 to 6 weeks of the year, awesome. Then they were horrible. Then things kind of picked up a little bit in March, and then things got bad again. And then pretty much for the rest of the year, what we saw is this decline in the percentage of stocks that were doing well underneath the market. This is Lowry's research. So Lowry's is one of the, I think it actually is the oldest technical analysis research firm in the country. And again, I apologize, it's a little bit blurry here, but I blew it up to make sure it was really easy to see. And what you're looking at here, then the black line, is what's called buying power. And in other words, when there's buying enthusiasm, in other words, a lot of buying enthusiasm or buying power, then this chart is going up. When buying power is waning, then this is declining, the black line. The bottom, the red line, is selling pressure. When there is a lot of selling enthusiasm, when there's a lot of supply as opposed to demand, then that red line tends to go up, whereas when selling subsides and we tend to see sellers walking away and more demand in the market, we tend to see selling pressure go down. What we've seen so far in 2021, I shouldn't say so far because it's over, but buying power peaked in February. I believe it was the 12th, if I remember, and then pretty much declined through the rest of the year. Yeah, it got a little bit flat toward the end of the year, but it was choppy at best. Selling pressure pretty much increased the entire year. Starting this, the figure at the left, by the way, 122 is irrelevant, but it's a relative point score. So 122 is where it started, and it ended here, as you can see, higher than it started that year. And then when you look at the market from July through the end of the year, so the second half of the year, what you have is this kind of change in leadership over and over and over again, where sellers are winning, then buyers are winning, then sellers are winning, then buyers are winning, then sellers are winning again, and we kind of finish the year with things pretty much locked, almost like a photo finish. And I know I didn't have a chart to show you, I just didn't get one in time, but when the market is crashing, typically what you see is the red line above the black line. So this isn't a short-term indicator that you look at and say, well, just because selling's up here means that there's no reason to be concerned. When the red line is above the black line, there is definitely a reason to be defensive. And so again, you can see how pretty much the whole second half of this year, well, let me back up. The whole year, almost the entire year, we saw a decline for the most part in buying power, an increase or a rise in selling pressure, followed by the second half of the year, which was pretty much a chop fest in terms of changing leadership to whether or not sellers were winning in the battle of supply and demand, or if buyers were winning. So again, it just kind of goes to show underneath the surface of the market indices, like the S&P or the Dow, we have this storm that was constantly going on, or call it volcanic activity underneath the surface. This is another example, and maybe I'm beating this horse to death, so I apologize if I am. But this is a tweet that was put out by Bespoke, and here you can see the average NASDAQ composite stock, and this was back on December 13th, is 39% below its recent high, its 52-week high, even though the index at the time was only 3.6 below its 52-week high. And then you can see here the average stock distance from its 52-week high by index. So the NASDAQ, 39%, while the index is 3.6. The average stock on the NASDAQ comp, so we're looking at a smaller sample of stocks here, above 1 billion. So this is, I believe it's the NASDAQ, well, it doesn't matter. Down 28.6%, down while the index is down 3.6. The NASDAQ 100, so the largest stocks on the NASDAQ, down 16.6. The S&P 500 down, I mentioned earlier, Thrasher's statistic, down on almost 12%. The mid-cap 400, so this is mid-sized companies, down almost 17% versus the mid-cap index down 4.6. And then the small-cap index, small-sized companies down more than 22%, which, I don't know if anybody cares about definitions, but by definition, most would call that, say, a market crash. So, in other words, small companies crashing under the surface while the index was only down, call it 6.1. And then here's more graphical details. This is the S&P 500 index, but the percentage of stocks above their 200-day trend line, their 200-day moving average. And you can see from pretty much the beginning of May, end of April, the percentage of stocks that are in a long-term uptrend were just continually going down throughout the year, with the exception of maybe we could say this last couple weeks, so the tail end of the year. Here's the NASDAQ composite. Now, the S&P was only 505 stocks, like I mentioned earlier. The NASDAQ is 3,000 stocks. And you can see this, again, same story here, just different index. Make a song about it. NASDAQ index, you can see in the top pane, bottom pane, percentage of stocks on the NASDAQ above their 200-day trend line, 200-day moving average. And as of, this is today, I just pulled this up today, so probably yesterday's closing prices, which would be Monday, Monday, January 2nd, 30% of the stocks, 30% of the 3,000 stocks on the NASDAQ composite trading above their 200-day moving average. And if I flip that statistic upside down, that's 70% of stocks on the NASDAQ trading below their long-term trend line, or in other words, trading in a downtrend. This is the New York Stock Exchange composite. This is everything you could buy in the stock market on the New York Stock Exchange. Again, same different index, same story. Again, we write a song about it. You can see the index in the top pane throughout the entire year. Percentage of stocks above their long-term trend line or 200-day moving average declining, and as of today, we've got 40%, which again, like I mentioned a second ago, this last few weeks has actually shown things have perked up. All right. I'm going to start speeding up here now because I'm going to get in, well, I'll speed up when I get to individual stocks. So this is the IWM. This is the small cap index. I call this Chop Fest 2021, or here's our chutes and ladders under the surface. And the start of the year, the end of the year, the market just going up, down, up, down, up, down. And since the November highs, so the market peaked, or I should say the Russell 2000 small companies broke out above their this previous level of potential resistance, became resistance. It broke out, and then it fell right back into that range and dropped 12.4% between mid-November and call it middle to end of December. So that was what was going on under the surface, or one of the many things going on under the surface. This is a comparison. This is called a relative strength comparison of this mid-sized company index. This is mid-caps. This is mid-cap index versus the S&P 500. So you can see on a relative basis how mid-sized company stocks, which are not tiny, by the way, we're not talking microcaps, how mid-caps have been performing relative to the S&P. Here's small caps, small company stocks, how they've been performing relative to the S&P 500. So this is kind of what's been going on under the surface from a big picture standpoint. And if that was too much, again, I apologize. But I think that kind of sums up the big picture. Now let's look at some of the details. Let's look at what some of the generals did. So let's look at some stocks that did well, and let's look at some stocks that didn't do so well. And like I mentioned earlier, it was a whole lot easier to find stocks that didn't do well than it was to find ones that didn't. And I cut out quite a few that didn't do well, by the way. So stocks like Apple did fine this year. Maybe kind of a struggle the first part of the year. You can see here that at the beginning, call it end of January, Apple was at the same place it was in October. But just in the last quarter, Apple just kind of broke out and it started doing very well. AMD, semiconductor stock, similar story. Kind of didn't really do anything for the first half of the year, a little bit more than half. Pulled back from August through October and then really did well through October, November, pulled back in December, and then started kind of rebounding in the end of December and into the new year. Google, a completely different story. One of the biggest stocks in the S&P 500, the NASDAQ. Google, a very, very expensive stock at over $2,900 a share. Hard for a lot of people to buy. Buying one share at $2,900, I wish they'd split the stock, honestly, but they don't care what I think. But you can see here, Google's one of these stocks. It's one of the biggest mega cap stocks on the major market indices, and this is one of the tails that we're wagging the dog. So you can see here, for the most part, just kind of went up all year. So we have Moderna doing really well for the first month and a half. Then we get a big pullback. And then the stock does well until about August. And then it's down 51% since August. Netflix kind of did nothing all year, right up until the fourth quarter, like a lot of stocks. Fourth quarter, a lot of these mega caps did really well. But you can see, even so, Netflix peaks out at around $690 a share in mid-November and then falls down to $590 and change by the end of December. NVIDIA, like AMD, is another semiconductor stock. It's one that I like a lot. But you can see here, again, similar story with February. Market peaks, stock peaks here as well, pulls back, higher high, higher low, higher high, higher low, and so on. And right now we got kind of a slight pullback on NVIDIA since the November highs, but not so bad. We peaked at around 330. It's sitting at around 301 today, I believe it was 301. Now, remember Cathie Wood earlier? We were talking about Cathie Wood and the ARK funds. She has the ARK Innovation ETF. She has the ARK Genomics Fund. She has the ARK, I believe it's Robotics. So she has several ARK funds, and she's a very, very, very good portfolio manager. This is kind of her flagship fund, the ARK-K, or the ARK Innovation ETF. And you can see here that, and this is as of today, you can see from the February highs that it's down 37% this year. So again, when we go back to her quote, and I'll see if I can go back to it real quick here, and I'll jump right back to our previous slide. But she said, "I've never been in a market that's been up or has appreciated, and our strategies have been down. It's never happened before." And it's just, that's the kind of weird, I don't want to call it crazy, but very strange, again, bifurcated market that we've seen underneath the surface of the major market indices this year, or last year in 2021. Here's the IBD 50 ETF, the FFTY is the symbol. The reason I always like pulling this one up is because this is ranked by Investors Business Daily as the top 50 growth stocks in the U.S. So basically it's a basket of stocks, 50 stocks, and it's deemed by an IBD or Investors Business Daily to be the top 50 growth stocks. Anyway, so here's biotech. You would think that in a market where we have a pandemic, we have lots of different types of vaccines and different things going on in the technology industry as it relates to healthcare and health sciences, that you'd also have biotech doing well, when in fact it's been quite the opposite. You can see, I didn't mark it here, the performance, but you can see the start of the year, somewhere in the ballpark of $143 a share, we'll call it. End of the year, right around 112, we'll call it. In fact, it got as high as 175 in early February, and now it's down at around 111. So biotech, again, not this is what's going on underneath the surface of the market. I only pulled this one up because it just goes to most of you have probably never heard of this stock before. Koós, it's not a well-known stock, but it does trade at 4.5 million shares a day. It is owned by 389 funds. This was as of September 21st. It was owned by 389 funds. And it was one of the Omicron variant candidates for an Omicron variant vaccine. And all of a sudden, at the end of December, it went down 90% in one day because the studies ended up being, they just threw out the studies, basically. They said the studies weren't any good. So Here's a stock that since it IPO'd in 2018 has pretty much been in a long-term uptrend. You know, you could argue in short-term, intermediate-term time frame, maybe there were changes in trend along the way. But all of a sudden, out of the blue, you could be sitting here looking at this stock going, you know what, it's holding these lows here, and it's kind of sitting in this range, and it's a good stock, biotech medical company that's got a hat in the ring, if you will, for the sake of getting a potential vaccine for Omicron, and you wake up the next morning and it's down 90% and hasn't done anything since. So again, this is what's going on underneath the surface of the market. I can't stand these stocks, but I'm going to share them anyway. AMC, the meme stocks, AMC and GameStop, I've got both of them here. You know, AMC, going back to January, you know, up as much as 3,000 or more, actually more than 3,000%, and then down 62.5% since then. But still, if you owned it the whole time and you never sold, not that anybody, well, I shouldn't say anybody, it's not fair. I have very little interest in going to the movies, especially the condition the theaters are in these days. If you like cracked leather recliners that don't work, and you like freezing while you watch a movie, then go to the movie theater. Otherwise, pull up your HBO app, your Paramount Plus app, your Netflix app on your TV, your Apple TV, and pay $20 and eat your own snacks in your living room and feel comfortable with your blanket. That's my recommendation. But this is a financial presentation, not a wellness presentation, so I'm going to shut up and move on. So again, AMC up more than 3,000%, go figure. That makes sense, doesn't it? And then down 62.5%, that makes more sense, but for the year up over 1,200%. Kind of crazy. GameStop, I should have put the performance on here because it's down quite a bit, actually. This is a logarithmic chart. So logarithm means that as the bigger the price goes, the smaller the increments get on the right here. So you can see up top, we're talking about a peak in this stock this year in late January, right around, I'm going to say $3.50 a share, and now it's at $1.52. So if that gives you an idea of what GameStop's done this year, it hasn't been flat. It's actually, well, it's up if you would have bought it down here and you held it the whole time. But again, they're closing GameStop stores. People are buying video games through subscription services on the Xbox. They're not going and buying used video games anymore. But still, through crowdfunding, if you will, and Reddit and things like that, we're seeing stocks like these do really, really weird, crazy things. Even though the economy is opening up and we're starting to see more travel, Carnival not doing so well. IPO stocks, these are initial public offering. These are stocks that have come out in the last, call it anywhere between 3 years ago and recently. More recently than that, these stocks, which you would think in a very, very good, healthy, fueled market that's doing well, you would think they'd be doing well. Well, they haven't been. So that's IPO stocks. PayPal, you would think that with all the online ordering and things like that, it would be doing well. It hasn't been doing well. Zoom, sorry I'm speeding up here, but I'm looking at the clock and I need to get moving. So Zoom video, we're all using Zoom. I'm not using it right now, but I use Zoom probably daily. And here Zoom is down 48%. It's down almost half of its value has been lost just this year alone. Uber, I think the economy is opening up. My wife and I, friends of ours, we've used Uber and Lyft a few times this year, but still not even close to seeing something that resembles an uptrend. And then China, it's not just domestic stocks, people. It's when we look overseas at countries like China who claim that they haven't really been affected all that much by COVID, like a lot of other countries have. I think claim is the infinitive word there. But you can see the KWEB, the China Internet ETF, is a basket of internet stocks, tech stocks in China, opening up the year around $80, $82 a share, sitting around like $36 per share. All right, I'm going to keep moving. Bonds and interest rates. We're going to talk about bonds now. I mentioned bonds were down for the year. Here's the U.S. Treasury yield. So this is interest rates, 30-year interest rates. Talk about a chop fest. Interest rates going up on the 30-year Treasury from 1.86, we'll call it, to 2.5-ish, back down to 1.82, back up to 2.14, down to 1.7, we'll say, something like that. And now we're sitting around 1.9. In fact, I think they popped yesterday and today, or maybe today they popped. So they could be a little bit higher now than what you're seeing here in this chart. Here's long-term corporate bonds. Long-term corporate bonds down 6.4%. So these are supposed to be the safe stuff. This is supposed to be the investments that are supposed to make our investment portfolio easier to swallow, not more difficult. Meanwhile, long-term corporate bonds down 6.4%. This is 20-year government treasury bonds down 9.1% as of midday today, since January 1st, 2021. This is the, I didn't do a performance run here, but this is the AGG. This is the basically a basket of not stocks, but bonds, a basket of bonds that represent the U.S. bond market. And it does, again, you don't need to be a rocket scientist to look at this chart and say, man, not a very good year for bonds. So that's the U.S. Bonds here as a whole. So let me get past all that stuff. Enough talking about 2021. Let's get optimistic. Let's look at the risks. Of course, we got to be objective and look at the difference between the good, the bad, potential risks, and what we might see coming into 2022. First of all, why might U.S. stocks struggle, or why might stocks struggle in general? More COVID variants. We could see surges in future variants that might come out. That's always possible. Or we could see COVID symptoms and mortality improve. Second, supply chain shortages might cause stocks to struggle. If we continue to see bottlenecks in the supply chain, that could be a problem. However, we could see stocks do well if inflation starts to reduce and the supply chain eases. If we continue to see labor shortages in the market in a lot of sectors, that could be a problem for stocks, while at the same time the opposite would be good, if the labor market started to ease throughout the year. If Jerome Powell, the Fed pres, if when he starts hiking rates, if he does it too fast, that could be a problem. Too much and too fast. But if he raises rates as expected or potentially even less, that would be good, of course, for stocks. And then anticipation of the midterm elections in November is definitely going to be an uncertainty that people are paying attention to. So I think that that's one of the reasons why we're probably going to see more volatility and choppiness through the first part of the year, call it first half of the year or so, maybe a little longer, first call it 3 quarters. But that once we have that uncertainty behind us, that things might do well. Other potential risks we need to watch out for: geopolitical problems like military conflicts in Taiwan or Ukraine, for instance. If we see oil prices surge due to OPEC, that could add fuel, no pun intended, to the inflationary fire, all while putting pressure on the consumer. Government could go after big tech, monopolies, and that could cause consumer confidence to begin to struggle. And then we could see problems with Biden, potential health issues, something like that I just threw out there because it's always a possibility with any president. If you have an issue with the president of the United States, you're going to have a problem with U.S. stocks. I think that goes without saying. And then in conclusion, I think what we look at here is that in 2021 was a year where we saw, again, the largest mega cap stocks. They made investing look like it should have been easy when the vast majority of investors' truths, their real truths, were completely a different reality. I expect next year in 2022 to see increased volatility through at least, I'd say, the first half of 2022, with the majority of any positive potential market strength, at least sustainable strength, coming in the second half of the year. That's just my guess. I guess for lack of a better word, I guess it is a prediction. I hate predicting, but it is what it is. And then the last time, just kind of a fun fact here, the last time we had 3 rate hikes in 1 year was in 2018, and the market ended up being down 4.38% that year. So a couple things I want to end today cup half full and positive, as opposed to worrisome or pessimistic. This is, I don't want to get into too much detail here, but this is a breadth signal. So the S&P breadth above the 50-day moving average, and then the S&P in the top pane. Whenever this blue line is above 75, the annualized rate of return of the S&P 500 is 16.8%. When it's between 65 and 75, the annualized rate of return is 10.3, and that's right where it's sitting here. It's sitting right on the line at 70. Here's another one. Wall Street still considers stocks to be undervalued. Think about that for a second. Why in the world would stocks be still undervalued unless there's lots of stocks that didn't do well and are still a good value, right? Makes sense. So when we look at this indicator, this is S&P 500 deviation from Wall Street strategist's next year estimate. So the following year estimate. Below the black line is undervalued, above the line is overvalued. And you can see here, again, using this little line up top here, the S&P, maybe some people don't think so. Everybody's entitled to their opinion. But when this number is below negative 5%, the annualized rate of return of the S&P 500 the following year is 9.5%. So again, that's positive. That's good. And then last but not least, we are now in a midterm election year. Midterm elections are in November, of course. And in those years, what we see, seasonally speaking, I'm going to focus on all midterm years. So what we tend to see is just the market kind of choppy for the most part and kind of sideways right up until October, after which it starts to shoot northward. You can look at these different colors of lines. First midterm year for Biden, it's his first midterm year. Democratic president midterm versus Republican. Second year, new Democratic president. So there's lots of different ways to skin this cat. And then all years average, which is irrelevant in this study. But since 1946, I think what I want to pay attention to is really kind of the congestion of these lines here. And that generally speaking, the market is flat or down for the first part of the year, call it the first 3 quarters. And once we get rid of that midterm elections uncertainty, then things kind of start to turn around and we start to see positive returns. That is all I have for you today. If you have any questions, if you'd like to have your situation analyzed, if you have any questions about your financial plan, if you don't have a financial plan, all this stuff we talked about today was very nerdy. All of it was very technical. The most important thing when it comes to your financial plan is just that. It's your financial plan. The market, stocks, bonds are like the wind. It's like the weather. And if you stand at the beginning of a marathon and you try to make it to the end of that marathon waiting for the wind to blow you there, it's not going to happen. You need to focus on how much you're saving, how much you're spending, your withdrawal rate. You need to focus on making sure you have a appropriately balanced portfolio that's diversified for you, one that makes the most sense. So if you have any questions at all, you never ever have to be a client to ask a question, so feel free to reach out to us at info@libertaswealth.com or just go to our website at libertaswealth.com and you can send us a form message there. And then again, if you'd like to get a second opinion on your financial plan, or again, if you don't have a financial plan and you'd like to go through our process, we have a 3-appointment process. It's a 2-hour discovery meeting to start. It's a 60-minute education meeting, second meeting. And then third meeting is a 1.5-hour financial planning meeting, after which we are off to the races. So that is all for this year's Market Outlook. Thanks for sticking around the whole time. And if you made it this far, that is. And Happy New Year.